And in our top business story, the latest economic data released by Emirates NBD has pointed to softer growth of Dubai's private sector at the end of 2015. The headline seasonally adjusted Emirates NBD Dubai Economy Tracker Index, which monitors operating conditions in non-oil private sector economy, posted at 51.8 in December, down from 53.4 in November, and signaled only a modest improvement in overall operating conditions. The figure was the weakest rate of improvement since July 2010, with slower increases in business activity, new orders, and employment all weighing on the headline index at the end of the year. At the subsector level, both construction and wholesale and retail businesses saw a slower improvement in overall business conditions. However, travel and tourism firms bucked the trend, with the health of the sector improving at the fastest rate since June. Commenting on the findings, Khatija Haq, the head of MENA research at Emirates NBD, stated that the slower rate of expansion in Dubai in December is unsurprising, given the headwinds of a strong US dollar and increased uncertainty about both the global and regional economic outlook. Additionally, the level of optimism towards the 12-month business outlook slipped in December, with Dubai's private sector registering the lowest level of positive segments or sentiments since this index began in April 2012. New product launches, marketing strategies, and expansions of improving markets conditions were all expected to boost output over the coming year. However, some panelists commented that an uncertain global economic outlook weighed on their growth projections. Saudi Arabia has retained its position as a top trading partner with Dubai in the GCC and Middle East region. Saudi Arabia has also been ranked as the fourth largest trading partner with Dubai on the global level throughout the first 9 months of 2015, with the Emirates non-oil trade with Saudi worth 44.65 billion dirhams, a 12% increase from the same period in 2014. According to the latest statistics released by Dubai Customs, the total value of Dubai's trade with the GCC states recorded 96.19 billion dirhams in the first 9 months of 2015, with an 8% rise compared to the same period of 2014. Saudi Arabia's share of Dubai GCC trade was 46.4%, followed by Oman with a value of 18 billion dirhams, representing 18.7%. Kuwait came third with a value of 14.87 billion dirhams, representing 15.4%. Then Qatar with a value of 11.91 billion dirhams, representing 12.3%. And finally Bahrain with 6.75 billion dirhams, representing 7%. 4- and 5-star hotels in Dubai continue to experience weakening average room rates in November, falling 6.9% to $315.3, whilst occupancy levels remain strong, but marginally lower than the same period last year at 84.9%. The 8.1% decrease in revenue per available room was compounded by significantly lower food and beverage revenues, which fell 12%, driving total revenue per available room 10.9% lower to $449.80. Higher operating expenses compounded lower overall revenues, reducing gross operating profit per available room by 15.8% to $214.83. Looking around the region, and occupancy levels plunged in Sharm el-Sheikh in November following the crash of a Russian civilian airplane in early November. A subsequent ban on travel and cancellation of flights to the region from Russia and various European countries severely impacted performance in the Red Sea destination. Occupancy levels fell 25.9 percentage points to 36.2%, resulting in a 42% drop in RevPAR to $17.94. Additionally, continued low oil prices are starting to have an impact on Doha's hotel market, as demand levels fell in November, with occupancy levels dropping 5.5% or percentage points to 75.1%. Jeddah hotels witnessed softening demand levels in November, with 4- and 5-star hotels recording a 3.8 percentage points reduction in occupancy to 70.7%. And although Beirut hotels witnessed a 3.7 percentage point reduction in occupancy levels to 58.2% in November, hoteliers will be able to yield significantly higher ARR, which rose 15.8% to $142.29. Etisalat's group chief executive, Ahmed Jafar, does not anticipate any increase in the royalties the telecom operator has to pay to the government or the UAE federal government, according to local reports. Amid the decline in hydrocarbon revenue because of falling oil prices over the past 18 months, analysts at EFG Hermes have said that the risks to the company's valuation include any future decision by the government to alter the current royalty structure upwards or even charge a different tax on services. Mr. Jafar made the comments on the sidelines of the Ericsson Change Makers Forum in Dubai yesterday, where he stated that they haven't heard anything from the government yet, but that our expectations is that the current regime in place, that is renewed every 2 years, should remain as it is for the time being. During the past 12 months, Etisalat's share have gained more than 62% since it opened its ownership to foreign investors, and its stock was included in MSCI's benchmark index. The royalty paid to the UAE government was one of the factors Etisalat signaled out as causing an 8.6% drop in the company's profits for the third quarter of last year, together with forex losses in Morocco, Egypt, and Pakistan. Etisalat's UAE-based operations continued to grow in the third quarter of 2015, with revenue and profit increasing year-on-year by 5.7% and 6.6% respectively.